Thank you very much, Paul. We're going to roll right into our next panel. So I'm going to invite David Kotok, CIO of Cumberland Advisors and a GIC board member, up to bring our next panel together.
May I have the panel, please? The panel is requested to take off their jackets and their ties.
Yes, sir. But I wore it all day, David. You should have told me that this morning.
I'm going to do this from up here. So I can do a Q&A, so I'll do it up here. Anywhere you want. Are the questions four close on one side? Okay.
Anywhere's okay.
Anywhere's okay. This is an egalitarian panel, I think. I'm missing one. One is lost. Here we go. You can tell him he wore the right shoes today. Following Paul McCulley,
Which is hard to do.
at the end of a conference that's all day, when the temperature is 85 degrees, is a little like being Elizabeth Taylor's sixth husband. Now, that said, we know what we have to do here. We're just going to try to find a way to make it interesting for you.
Are you going to finish the last part of that story?
So here's what we're going to do. Here's how we organize this panel and discussion. This is about financial markets, investments, outlook, a little freewheeling time, a discussion at the end, or maybe I'll encapsulate it and add a word or two. Then Justin Hyde wants the last 6 or 7 minutes, so we'll give that to him. In our conference call, we arranged the following rules, and I'm going to let everybody in this audience be the judge of adherence to the rules. I asked the panelists for one slide.
Are these parameters or the variables?
I hear a voice. I don't know what that is. I asked them for one slide. There then ensued a 20-minute debate. And at the end of the debate, we agreed contractually, I have witnesses, to 2 slides. Now, you'll be the judge. You'll count the slides. Next. We agreed that the opening statement by each panelist will be 6 to 8 minutes. I'm then going to ask each one of them a question. They know what that question is, so they've had a little time to prepare. I'm going to follow it with a lightning round and give them 1 minute each. They don't know till now that's coming. And then everybody in this room will have a chance to ask any panelist any question. I'm only going to ask that it be within 1 minute and the panelist answer within 1 minute so we don't have alternate speeches. So those are the rules of the engagement today. The questions up? Jill, where are you? I can't see. Are they up on the screens? Okay. The statements. So these are the opening statements. Here it is. Okay, I got a copy. So I'm a disabled person. I have one eye, and it decides when it wants to work and when it doesn't. Paul O'Brien's, you see it? This time is different. John Silvia, it is never different. Actors change, the play is the same. Dick Mayo, this may be the decade it's hard to make money. Must act tactically. And Bill Kennedy, demographics are destiny. Everybody knows their opening position. They've all seen these questions. Bill Kennedy, 6 minutes and as many slides as you have, up to 2.
Thank you, David. So let me start with our framework for asset allocation and then turn into a conversation about our cyclical view and then a more structural view that has to do with demographics. So if we can go to the first of two slides, please. Thank you. So we are in the business not of forecasting, but trying to help our clients prepare. So we spend all of our time thinking about things that we can control as opposed to things we cannot control. We cannot control where markets are going to go. We have no idea what asset returns are going to be. But there are two things that we think clients can control, investors can control. The first is your time horizon. Thank you. Any investor has the ability to adjust their time horizon to meet their risk tolerance and their underlying needs. And the second is how much risk and what type of risk they put into the portfolio. So the slide in front of you gives a parameter of how we think about risk. On the horizontal axis, you'll see growth. And so when growth is accelerating, you want to invest in those assets that have predictable risk characteristics during accelerating growth. On the left-hand side, it's decelerating growth. And on the other axis, it's based on inflation. And so what we spend our time doing is looking at the incremental change in growth and the incremental change in inflation to help us decide what economic regime prevails. As we see the world today, we believe that we are in a decelerating growth environment and a decelerating inflation environment. The degree of that matters, but what that would suggest is that we should see, and David, could I ask you to just step one to the side? So what you would expect, assets such as cash, gold, and certain fixed income securities should outperform and during that sort of regime, a regime 4 or even a regime 3. We have seen a lot of slides today that look at the S&P 500 and how great those returns have been, certainly over the last 10 years. The reality is, since September of last year, the bond market has outperformed the stock market. And that has been the case since September. When we went through the growth scare in the fourth quarter, bonds outperformed. That reversed in the first quarter, I think in part because of the Fed changing the narrative from tightening to neutral. But in the second quarter of this year, we've seen bonds outperform again. And so our view right now is that we are in somewhere on the left-hand side of that scale. Now, the degree of this, there's a big question whether or not we are in a recession. We don't know. We can't predict that. I would refer to our friend Don Rissmiller and the work that they do at Strategist. Business cycles don't die of old age. They tend to end because of one of three factors. There's a monetary policy mistake, or a fiscal policy mistake, or some exogenous factor that occurs. I would say we've hit the trifecta in the last 12 months. I think in hindsight, the December rate hike will prove to have been a mistake. And the Fed seems to be trying to correct that now, but what they are not correcting as of yet is that they're still extracting liquidity from the system by shrinking the balance sheet. So as long as quantitative tightening is still in place, I think that we would chalk that up as a monetary policy error. The fiscal policy error, you heard it from Paul, I think it has to do with trade. And all the good things that happened from the corporate tax cut have been mitigated by the bad things that have been happening from trade. And in terms of the exogenous factor, I think we heard it last weekend with regard to the news about Deutsche Bank. Deutsche Bank has been death by 1,000 cuts. The problems with Deutsche Bank have been around for 3 to 4 years. But I think when we get around to this conversation a year from now, we may look back to find that the Deutsche Bank story happens to be the exogenous component. So we don't know that if we're going to be in a recession in the next year or so. We think it could feel like one as we come into the second half of this year. So in terms of how we're advising our clients, it's to stay on the left-hand side of that target in either regime 3 or regime 4, and trying to identify those assets that perform the best in a slowing growth environment and a decelerating inflation environment. Now, if you could go forward one slide and then quickly go forward to the next slide, so I can stay to my 2. Thank you. Okay, so here's the optimistic side. And we've heard a lot about labor force participation and the private sector giving way to the public sector. What this chart is showing you is the labor participation rate on the blue line, and we've fallen from 66% down to 63%. In Jeff's presentation this morning, some very good commentary about why that is, roughly half of that because of demographics and baby boomers coming out of the workforce. The red line represents the Fed's balance sheet. It's inverted. So as we have seen the private sector economic capacity weaken, we have had to rely on monetary policy, the only game in town, to help out. And that's what you see in the red line with the Fed balance sheet going to $4.5 trillion. We've tried to shrink the balance sheet. You see the line moving up, but the labor force participation is not moving, and that leads us to the decisions that have to be made by the Fed in the coming quarters. So here's the good news around the demographics. Anyone want to guess what the single largest age group in America is today? What year? How old is the largest group in the United States? 72? 53? It's 27. At the end of this year, the millennials will be bigger, 73 million, versus the boomers at 72 million. And I have to tell you, at lunch and throughout today, I've had the opportunity to meet some millennials here. We're in good shape, folks. Don't worry, we've got some great talent, but even behind the 73 million millennials, there's 76 million Generation Zs coming into the workforce starting in the year 2024. There's great hope that this blue line, because of the increase in the workforce, that blue line will start to move forward. And as that happens, our hope and what we're anticipating is that we would move to the other side of our target in regime 1, regime 2, where you have faster growth, you have more consumption, you have less Fed. And so with that, David, I guess the way that we would summarize our view right now on the markets, we're cautious that we think the sun might be setting on this business cycle, but we can see some optimistic opportunity going out to 5 years from now. Thank you.
Good opening from Bill Kennedy. Thank you, Bill. We're going to get to the question round. We want to get through 4 presentations. John Silvia.
So again, the guideline for me was to try to provide a framework of where we are in the economy now, so make some judgments going forward over the next 6 months to a year, so we can see how the progress of the economy goes forward. Yeah, David gave me a guide of nominally 2 slides, but quality adjusted, I ended up with 3. So. There you go. So most of you are pretty familiar with what I write, and I really stick to 4 sectors of the U.S. economy. And again, these brilliantly constructed quality adjusted slides are available on the GIC website, so you don't have to scramble to write them down. But anyway, very quickly, I stick to these 4 sectors because I want a framework, and every time I do an economic presentation. So I talk a little bit about the output, the credit markets, trade, and the equity capital markets. And just to remind you once again, change is constant. We never really go back to the old place that, what are you doing? I told you the slides are available.
But I want your beautiful face.
Oh, okay. So again, change is a lot of people are saying we're going to go back to equilibrium, and the equilibrium is always changing, so we don't do that kind of stuff. Change is constant. So very quickly, oh, hold on. Yeah, I really try to differentiate the real side of the economy and the financial side of the economy and try to focus in on things. What I look at in terms of the business cycle, and I avoid trend. I mean, anybody can tell you next year's GDP is 2.5% or 2%. That's really pretty useless. What I really want to know is what are the signs that the cycle may be changing over time. Always use jobless claims. And again, going back to, what was referred to earlier by Paul in terms of 2008 and parameters become variables. I do a lot of statistical work, and I always say, is there a structural break in the series? If you use state space analysis, is there a structural break? And absolutely. And that's one of the interesting questions about jobless claims. Is 300 the bright line anymore? Or is it some other number that we really need to focus in on? ISM manufacturing numbers, as you can see, still a little bit above 50. Factory orders up about 2.5% year over year, but definitely slowing down over time. Building permits, again, where we are above the last 3 months. So you kind of get a feeling when you look at confidence in the business cycle, we're still doing okay. We don't have cyclical indicators that the economy is weakening going forward. And then finally, again, just an amazingly brilliant slide. This is the, I know, it's amazing. Aren't you like, wow, I'm glad quality adjusted this slide get in here. Anyway, so on the financial side, what we're looking at is the equity market, again, being very, very positive. And yes, it is true, as someone mentioned earlier, the S&P 500 is one of those leading economic indicators. The dollar index is up slightly since the start of the year. Corporate profits have slowed down. But again, that's one of the interesting weaker issues, and leading indicators still a slower rate of growth. And as someone mentioned earlier this morning, quality spreads remain relatively unchanged. So that's the context of the economy going forward. These are series that I monitor all the time. And as Justin and Randy know, I give them a monthly update on these numbers all the time to keep them straight. It doesn't really help with them, but I do my best as I can with them. And that's it.
Thank you, Joe. Dick Mayo absolutely pledged adherence to the parameter of 2 slides.
Phenomenal parameter.
And he's already calculated. Dick Mayo, your 6 minutes.
I tried to hedge a little bit. If you look at some of my slides, if you go to the next slide, I snuck 2 or 3 ideas on one page. This is one thing I want to talk about. If I was putting a title on this talk, I would use what Tobias Lefkowitz said at Citibank. He said, keep driving, but potholes are ahead. And so that's the orientation I want to get across here. I have great concern, Bill used the word regime change. I think that's appropriate going forward. I can see a series of things you have to talk about, deglobalization, a whole series of things like that. The purpose of this picture, which everybody else in this conference has sort of confirmed, is trade, competition, trade strategy is here to stay. And to me, that's very important because I think we can now use the phrase, remember the last decade we sort of used synchronized global growth. I think we can now use synchronized global slowdown. It's interesting that we focus on China and we focus on the United States, but things are popping up in other places. We seem to have opened the envelope for more things to be considered. India, why are we doing that? South Korea, Japan, why is that happening? We've sort of lowered the bar. And just out of respect, I threw Tom Barkin's comment in here. It probably didn't make the local papers, so now you can see this. He's sort of in the same camp. Now, up top, to me, is one of the most important charts. This shows trade growth slowdown. Unfortunately, I didn't have the one I most wanted to use. I live in 2 places. Whenever I want a chart, it's always in the other place. But if you looked at a 50-year chart of trade growth, you will see from 1980 to today, trade growth has doubled. Since 2008, 2009, it's actually declining. I think the growth slowdown that we're experiencing for trade and also an adjustment of logistics change is going to continue to create a slowdown. So to me, that's one of the most important things to be thinking about. Now, next page. And this is where I really cheated, the 3 ideas here. If you look at the top chart, you'll see the experience of profit margins over the last, was it 10 years? We've gone to all-time record profit margins. How did we do that? Globalization was one of those. Move your factories, move your assets to the lowest cost places. We've had a series of other mechanisms which I think have been important here. If you looked at 5 to 6 percentage point drop in margins, 2 of us come from tax rates, 2.5 come from lower interest rates, 1.5 has come from lower depreciation. I think that's behind us. So I no longer have that as a tailwind. As the growth slows, and to me, one of the fascinating things to me, if you talk to people in China, you talk to people in Japan, you talk to people in Europe, talk to people in Canada, what is their main thinking process today? This trade situation, I'm not going to let it happen to me again. If I need the semiconductors in China, I'm going to make them here. If I need steel in Canada, I'm going to bring the final product here. All those things are inefficient for profit margins. So I think we have to incorporate the idea profit margins will be declining. Now, one of the other things which I would like to get you to think about. I have the privilege of teaching a seminar at the Darden School at University of Virginia with Bob Bruner. Some of you may have read his book, 1907. He's an expert in financial crisis. And over the years, we've gone through, you wouldn't believe how many financial crises there are. Over the years, we've gone through each one, and there's one thing that comes across pretty consistently. In the previous cycle, something new was developed. Some financial product was developed. You can go back to 1907, which was in the book. That's when they created the trust banks. They were outside the normal banking system. They had the ability to leverage when the others didn't. You can go into the Depression. What was created? Investment trust. They figured out how to leverage those mechanisms. Fast forward to 1987. What happened? You created portfolio insurance. So everybody could be more invested than you would think, because when it came time to go the other way, your agent for protection would sell futures and you would be okay. I point that out because I want to come back to that. Everybody knows what happened in 2008 and 2009. The new products, whether they were CDOs or CLs or whatever, this long laundry list of alphabets. What had happened, they were created for valid purposes, and everybody learned how to use them in an offensive manner. So it fell back. So I think about this particular cycle. What is new in this cycle that I should be worrying about? You economists can tell me, but I've never seen $13 trillion in negative interest rates. When growth slows or whether there's stress on the system, I don't know how it's going to evolve. One of the most important things today is we now have $5 trillion in ETFs, all created in the last decade. And I'm not sure, but it probably doesn't include the $1 trillion sitting in a bond fund. And take that one step further. I don't know if it's correct or not, but I've been told that 80 to 90% bond trading is done by computer now. So we're assuming everything works. An additional thing, stock buybacks when I first came into the business didn't exist. They didn't really exist 15 to 20 years ago. We've gotten to the stage now where they're humongous. The biggest buyer of equities of the last decade has been corporations. You may say that's okay, but if profit margins go down, cash flow goes down, I have less for stock buybacks, and go look at any company where there's a change in management or get in trouble, what's the first thing? We're putting the stock buyback aside. So in the next cycle, do I have the same demand I thought about? Now the last thing, or two less, we've developed options, whether they're VIX options or whether they're a whole series of other things that are here to manage volatility. And I would argue that exercise has caused people to probably be more invested than maybe they should be because they're comfortable, they are protected. Now, let me quickly get to the next slide. 1 minute. 1 minute, yes, sir. Okay. This is, no, you went too far. Oh, there it is. Excuse me, go back. Volatility is a great research effort done by this particular fellow at Bernstein. Everybody looks at volatility. If you look over 100 years, it's averaged 16 to 17. It hasn't changed. But there has been a change. If you look at the second slide, what you will find is volatility used to be more 10 to 15%, and that happened with some frequency. Currently, you have a different situation. You stay in long volatility period, long low volatility period followed by sharp accelerations in volatility. The average looks the same, it has different dynamics. You saw it manifested January, February last year. You saw it November, December this year. But now, fast forward, what happens the next time? As passive products have increased in share, and some people say it's 50 to 55% of the total, the next time you have a decline, there are fewer buyers to mute the volatility. The passive owner does nothing. It sits there. The active manager has less money to employ. As you see in many places, the corporation doesn't step up to the plate. With vigorous stock buybacks, how did we get the decline we had in the fourth quarter? They wait till it's over. So I think running portfolios in the future is something you better think about. Slower growth, lower profitability, probably lower valuations, and you better figure out how you're going to avoid the painful effects of that kind of volatility. You need to think about how you can turn volatility to an advantage and not a problem. Simply said, if bonds and stocks may go down, we're all going to have to learn how to manage tactically, and that means running above average cash reserves.
Thank you, Dick. I might add that all of us flew here on an airplane, and Dick flew in the no smiling section of the plane. Paul O'Brien, 6 minutes.
I actually drove over the pass this morning, David. It was great. There was nobody else on the road. It was first time I've been able to do that. This time is different. Those are known as the 4 scariest words in finance, and I'm not using them lightly. But the next 25 years are going to be very different than the last 25 years. And the way you invest in the next 25 years is going to be very different than you've been investing in the last 25. And I'll try to explain why I think that's the case and offer some investment advice. Although, health warning, I'm not licensed to give investment advice in this state, so take my advice as you will. Now, Paul McCulley really started this conversation, and he covered a couple of differences that I'm not going to talk about. Things like inequality, populism, political change. Those are very important. And he didn't mention, and none of us have mentioned today, climate change, which is an enormous sea change in the world economy. I'm not going to talk about it, but climate change is kind of an analogy to the sort of changes I see in capital markets, because it really, the climate's changing. The business cycle, recessions, those are weather. Those are seasons. Behind them, the climate is what's really going to change. So my first slide, please. And this slide is going to do double duty, both to talk about the US-China competition and to talk about technology. I took this off a great website, top500.org, which looks at the 500 largest supercomputers in the world. And the blue line is the number per country. And China has about 200 and some, the US is close to 100, and then it tails off rapidly. But don't feel sorry for the United States, because the green bars are the aggregate computing power of those 500 supercomputers. And there the United States has about 40% of the aggregate total. China's a good third, and again, everybody else tails off. So first point is the US-China competition. And as Michael pointed out this morning, it's a strategic competition. It's been a century or more since the two greatest economic powers on the planet were also strategic competitors. The US was an economic competitor of Japan in the 80s, but there was no strategic competition. We were a strategic competitor with the Soviet Union, but there was never any economic competition. You've got to go back to the 1890s, the turn of the 20th century, England and Germany, to find a comparable solution. None of us have invested in this environment. What do strategic competitors do? They put strategic interests ahead of economic interests. Yeah, tariffs are bad. They hurt GDP. They raise inflation. But that's not the game. The game is to limit the rise in technological advancement of China. And like Paul, I'm not a great fan of the president, but I think he's absolutely right to bring economic weapons like tariffs into political strategic competition around the world. You have to do that. Excluding Huawei from our 5G phone networks is going to make our phone networks more expensive. But that's the cost of having that strategic confidence that they're not going to be listening in on David's phone calls. You pays your money and you make your choice. But importantly, competition makes you stronger. People waste too much time trying to figure out whether China wins or the United States wins. They both win. It's the rest of the world that loses. You're going to have a duopoly, a very powerful duopoly, probably a somewhat cooperative duopoly, but those are going to be the poles of strength in the world. Now on to technology. This chart is supercomputers, but I could have used artificial intelligence research, autonomous vehicles, 5G telecom, almost any area, artificial intelligence, you'd see about the same ranking and about the same relative magnitudes. The US and China just dominate the tech sphere. Name a large tech company that isn't in the US or China. The key to modern digital technology is increasing returns to scale. The more experience you have, the more data you have, the more miles your artificial vehicles drive, the better you get. Those two, I didn't change the chart yet. Those two countries on the left are just going to be dominating tech, which is the fastest growing technology part of the economy. So what are the investment implications? Well, first off, as I said, US and China win over Europe, over Japan, over emerging markets. Your equity portfolio, country weights, should look like that chart. And yet, if you're following MSCI, you're nowhere near that. MSCI All Country World Equity Index has 5% in China. That's crazy. That's not where you want to be. You have to take control of your asset allocation and tilt it towards countries, sectors, economies. They're going to do better in this modern world. An index is not an optimal portfolio. It was never intended to be, and at a time like this, it certainly won't be. And I don't think value is coming back. Technology disruption destroys value. The winners win, and then they win some more, and then they get bigger, and they hire lobbyists. I just don't see that changing anytime soon. The winner-take-all economy in world is not one where value is going to beat growth. Now we'll go on to the second page, second chart. There have been three phases in interest rates in most of our lifetimes. They went up until 1979 or 80. This is US 10-year note yields. Then they went down for 30 years until maybe 5 years ago. I think we're in a new phase where they're flat. Because I don't think US bond yields are going to go materially below zero. And I don't really think they're going to go up again. There's too much debt on the planet, too much dollar debt for the economy to survive higher interest rates. But maybe they go up. I wouldn't exclude that. But I would pretty much exclude that they go down. Now, if you look at this chart, you'll see interest rates have bottomed at a lower and lower level each cycle until now. Where are they going to go in the next recession? They've typically fallen 400 or 500 basis points in a recession, providing a nice lift to a balanced portfolio. That's not going to happen next time around. 10-year note yield is 2. Where's it going to go? 1.25, 75 basis points? That's nice, but that's a total return of 5%, not the 20, 25% total return that you've gotten in the past. And, I mean, Paul has already discussed monetary policy. It's going to be very different in the next cycle, and that's a real problem. Are we going to have massive QE? We don't know what's going to happen. I think it makes it very difficult to manage portfolios. So, again, investment implications. If you've got a balanced portfolio, say 60-40, 70-30, you're getting the real return on bonds plus 60-70% of the equity risk premium. So that's 0 real plus maybe another 2% real. So a balanced portfolio is going to give you 2% real, 4% nominal from here. That's a lot less than most of us are used to, and that's a lot less than the spending commitments of foundations and endowments. Bonds are going to be poor diversifiers. As I said, they can't fall as much. So check your risk appetite. Are you willing, how big a drawdown are you willing to tolerate in the next recession? And make sure it makes sense in terms of how interest rates can fall. Because all the asset allocation models out there don't put a floor on interest rates when they calculate that. That fall in interest rates has been a tailwind for asset prices for the last 30 years. Everything does well when the discount rate falls. Well, if the discount rate's going to be steady or higher in the future, asset prices are going to depend on cash flows. You're going to see a lot more dispersion among assets. So I sort of agree with Dick. Not that you're going to be more tactical, but you're going to have to be more selective about choosing good businesses with growing cash flows. Favor yield over price appreciation. And finally, save more.
Thank you, Paul. Jill, how much time do we have? 15? 20? What's left? I didn't hear. My hearing aids can't hear you. 25. Okay. I'm going to limit the panel to 2 minutes to answer each question. I have some comments to add to that. Then we want to go lightning round around the room. We won't do a second lightning round from up here. You'll have a chance at anybody you want up here. So, Dick, 2 minutes. Hard stop. What is your single best investment idea right now? 2 minutes.
Yes, sir. My best idea at the moment, I say somewhat with trepidation, for the last 6 months have been buying gold stocks for a very simple reason. I think we've reached a stage where the man who created Barrick Gold, Peter Monk, said, how do you decide when and not to buy gold? He said, gold is an echo chamber of anxiety. I think we've reached that stage where the anxiety is elevated. Most people won't do that because they hadn't worked for a decade. But I think you now have a double whammy. Notice how gold has been working at a period of time. People hadn't been paying attention to it. But something happened this cycle that's different. Newmont Mining bought Goldcorp. Barrick tried to buy Newmont. These are the 3 or 4 biggest companies. They are consolidating. In the consolidation, they're cutting costs. The consolidation with Barrick and Newmont in a joint venture could save $750 million. And the simple conclusion here is you've never seen a period of time you could own a gold stock that has a 5.5% free cash flow yield.
Thank you. Bill, you're in a boutique community bank. How do you see the future for your size bank and your type of organization? Boutique Wealth Management Community Bank. Bill, 2 minutes.
So we have 2 businesses. We're spread lenders and we're problem solvers. And on the problem solving side, that's what we do around the wealth management. It has to do with family governance, dealing with philanthropy, dealing with transfer of wealth from one generation to the other. Everything I do on the investment side is the tail that wags the dog. In the next 10 years, there's going to be something on the magnitude of $50 trillion of wealth transferring from one generation to the next. All of that bull market that we've been talking about in the last 11 years of this conference, and even prior to that, is going to be transferring. And there are great complexities in trying to give advice as to how to do that in a a family-friendly manner and a tax-efficient manner. So while the demand for advice is going up, the supply of advice is going down. And what I mean by that are there are only about 300 to 400,000 advisors only in the United States today, and they're all boomers for the most part. And so we've got this mismatch where ultra-high net worth families with the types of problems that we deal with, that demand is going to be rising, and you're seeing a decline in the supply of advice. And so I think what that leads to, David, is both for the commercial banking side, where we have 5,500 banks in the United States today, I think we'll have 2,000 10 years from now, if not less. And in terms of the types of advisory firms that you see out there, the things that are going to matter are scale, use of technology. I can tell you that G2 and G3 and G4 do not ever care to step foot inside a bank branch or even talk to an advisor. They want to know who their advisor is, but they're going to use technology to get there. And so I think you'll see consolidation in the industry and a huge opportunity for fintech to play a big role.
Thank you. Paul O'Brien. Paul O'Brien was the strategist for a small fund called the Abu Dhabi Sovereign Wealth Fund. We do not know how large it is, and it would be, I think, a violation of his rules to tell us. I just know their estimates. They start at some numbers of hundreds of billions and go up. And I can say I knew Paul O'Brien many, many years, and I knew him when he was poor. Here's a question for this group. From a large, global investor's perspective, with a long time horizon, how do you select which sovereign debt to own? 2 minutes. 2 minutes for that 4-hour response.
That is a really tough question, David. It was a question we grappled with in Abu Dhabi. And actually, I was at a central bank conference in China last month, and it was a question being grappled with there. At ADIA, the answer was sort of easy. The currency to that country is pegged to the US dollar. Oil revenues are booked in dollars. And when the government wanted money, they wanted dollars. So it kind of made sense for us to keep score in the portfolio in dollars and measure it in dollars. What I think is a more interesting answer to your question, David, is the nervousness around the world of non-US investors with their heavy exposure to the US dollar and to the United States. And it's a big concentration risk. You probably don't mind if 70% of your portfolio is in US dollars or in the US, but if you sit in Abu Dhabi or China or Europe, you care a lot. And there is a big search on for an alternative to the dollar in portfolios. Unfortunately, there aren't many other good candidates. You have to pay 40 basis points in negative interest to own euros. You have to pay negative interest to own yen. And that is why I think gold is getting another look, because it is effectively it's a currency, and it isn't issued by a central bank, and no one's going to depreciate it. And the United States is not helping itself with sanctions, extraterritorial jurisdiction, JASTA, which really worries people in the Middle East. So there really is no alternative to the dollar in terms of liquidity, access to a payment system, and so on. But you're beginning to chip away at that exorbitant privilege of the US dollar, and I think we do have to keep that, all of us, on our radar screens going forward.
Thank you. Fourth question, then some comments from me, and then we'll get to some questions. John Silvia, I know you since I cannot remember how long. During your career, you were the chief economist to the U.S. Senate Banking Committee when Phil Gramm was chairman. In your career, you were one of two people in the United States that read the Federal Reserve's testimony a day before it was public. Your job included briefing Chairman Gramm on what was coming and preparing him for the Q&A. Tell us today in 2 minutes, and in a way this is linked to Paul McCulley's political comment. Tell us your assessment today of the banking committee and the politics that involve the money and central bank of the United States.
Well, when I was the chief economist of the committee, you're quite right. I would get the testimony the night before, and I would talk to Graham's chief of staff and the senator early in the morning, and then I would talk to a number of the staff for the other members of the committee. I would say that it was pretty clear to me that people like Bennett, Enzi, Allard, Bai on the Democratic side, Sarbanes on the Democratic side, really thought about these issues. And I would say the biggest difference that I see today with both the House Financial Services and the Senate is that, at least my experience on the Senate Banking Committee, people really did ask about the issues. Quite frankly, I have felt that, since George W. Bush and Barack Obama and now Donald Trump, when you listen to the questions that are being asked, it's more often attacking questions about personalities and really not about the fundamental issues. So I find it very discouraging there in terms of it's all questions about, it's like I gotcha question. Come up and say this so I can get a headline. It just drives me nuts. So I think there was a lot more content back there. And I will say, quite frankly, Sarbanes and Graham did work together very well. I think Bai on the Democratic side was, a basic Midwest values, and he contributed a lot to some of the broader issues with respect to the IMF and World Bank at the time. So I thought that was pretty good. I just want to comment a couple of things, if you don't mind, in my 2 minutes. I did leave a copy of my newsletter there. It's free. If you'd like to get on the distribution list. But I'll go back to the very first question you asked. And, with respect to, is it different this time? To me, it's never different because you're always dealing with an economic cycle and a credit cycle. And to me, that is so important to understand that this cycle, but the actors always change. I'm very familiar in the early 1990s with banks and commercial real estate, very, very familiar with the dot-com bubble. Very familiar with the housing bubble, and so it goes up and down. And so, if I may, just very quickly, I have to ask these questions. The Fed talks a lot about leveraged loans. To me, I'm looking at the regional banks and thinking, how many leveraged loans do these people hold? Because the big banks are not the problem on leveraged loans. To me, it's the regional banks. Second, the equity market, especially some consumer stocks that many people probably love here: Snap, Uber, Lyft, Tesla, and WeWork. I mean, these companies don't make money in a booming consumer economy. What happens when you have a slowdown? Are they going to make money selling less? I mean, it doesn't make any sense to me. And WeWorks make no sense to me at all. All right? Their losses exceed their revenues by $1 billion. They're going to issue a debt before their IPO. Okay, I am a dividend income investor. There's no way in hell I am buying WeWorks at any price. And so you want to speculate, that's fine. And the other final point, and maybe Paul has a view on this, I've got a high-yield European corporate debt with negative interest rates, negative returns. How does that make any sense to me as an investor? So that's a little bit off, but you could probably calculate the total return of a 50 basis point increase in interest rates when you've got a negative return on the instrument.
Good responses. Let me add two things, and then let's get into a dialogue with the panel. And Jill will have a microphone, and we'll ask you again, brief question, brief answer in the remaining time. Two observations. The first one's a little complex. What is the difference between a euro today and a euro 100 years from now? 1%. That's the Austrian bond priced in the market yesterday. What does that tell you about the intertemporal relationship between the value of money? And when you look around the world, we look at all the money in the world, and it's all fiat currency. And as you heard from two of the panelists, they alluded to the fact that it really has no value other than the wisdom of the regulatory authority to attempt to structure, change, maintain, or alter in some way the value. Paul said it in his remarks. There's a comeuppance coming. Now think about this. If a couple people saw the column this morning by John Authors on Bloomberg, and John is a longtime friend of mine and moved to Bloomberg and is now writing a daily column there after 20 years at the Financial Times. And if you're not getting his column every morning, I would encourage you to go to Bloomberg, sign up, and log in and yell at me in a few days if you haven't found a gem or a pearl in the words. John Authors and I have been back and forth in conversation about this kind of question. And John also has a Book of the Month Club. And in that Book of the Month Club, he's got George Magnus's now new book about China, which I would recommend people read. In it, Magnus talks about the currency issues. And he talks about chapter 5 in the book. And he talks about the issues, and he invokes Robert Mundell's famous Trinity. And what Mundell essentially said was, you can, as an authority, central bank, regulator, government, you can control monetary policy, move it up and down, change the interest rate. You can deal with the value of your currency vis-a-vis some other currency. And you can intervene in capital flows. What Mundell concluded was, you can do any two of the three, but you can't do all three at once. And that has been a guiding general principle for decades in our profession, business, Ouija board practitioners, whatever you want to call us. So I asked John Authors a question. After watching markets change, after watching China reduce US dollar holdings in reserves and raise gold, after watching India raise gold, after watching Russia raise gold, after watching Venezuela run out of everything, sell 200 tons of gold to get cash because it doesn't have anything else to sell, and the price of gold rises. Who are the buyers? All those institutions. So I asked John Authors a question. I said, you recommend the book, and I do too, and you allude to the Mundell construction, but the Mundell construction was designed when money was fiat currency exchanging with fiat currency. And then I asked myself a question. What are the characteristics of money? So Paul and I had this discussion earlier today. Well, what are they? First of all, medium of exchange. We make payments in dollars and euro and yen all the time. Secondly, we use it as a measuring stick, a unit of account. That's how we establish something. What's the third one? The store of value characteristic of money. Money started with the store of value characteristic in Athens 2,400 years ago when the Athenians created the drachma in silver and never diluted it, even when they lost the war to Sparta. Sparta did not adopt a new currency. It maintained the Athenian al. It was the first world reserve currency throughout the Mediterranean for hundreds of years. It survived the Greek city-states. Why? Trust, we heard it last night. A regime which was focused on its importance. Paul alluded to when you change a regime and when you don't. So I asked John Authors a question. I said, does the Mundell trilemma apply if the store of value characteristic is wounded? In my opinion, if a euro today and a euro 100 years from now are the same, The store of value has changed forever. That triggered a flurry. And if you get John Author's column today, you'll see part of that flurry. So the next dilemma for the portfolio investment manager is if the store of value characteristic is not in the money, where is it? Because nature abhors a vacuum. Is it in a Bitcoin? Is it in a gold coin? Is it in an asset price construction? We heard talk about an asset bubble. That's a fundamental approach in an economic construction that I believe Paul McCulley is right, because it will get introduced into the debate. I have a column out today. It supports the appointment of Judy Shelton as governor. Why? Does she have all the answers? I don't know. She will spice up a debate away from groupthink, because we have to have this kind of discussion, in my opinion. So, where do we go in the investment climate from here? It's going to be fun, and it's going to be different. And the only thing you know is it's not going to be more of the same. That's a great challenge to stay in this business and keep going. All right, we have a panel, we have a microphone, and we want 1 minute questions and 1 minute answers. Say who you direct the question to. Please, Jeffrey.
I'll ask Dick this. We've talked about debt. No one's mentioned state or municipal debt or underfunding of pensions. Could that potentially be large enough to be a macroeconomic event and not just a local event? Asking for another friend who lives in Chicago.
Say it again. What was it?
The question, Dick, is could something happen to state and municipal debt and the underfunding of pensions in a select few states that would be a large enough economic event that it has macro implications, not just local?
Yes.
Thank you.
Next question. We'll end early if we don't have a question. That's all right.
Well, let me say this with respect to your
Wait, there's a question right here. Sir.
Unfortunately, the states that are most focused on are Connecticut, Illinois, and California, which tend to be Democratic states. And if it's perceived that the federal government is going to come out to the bailout of them, it's going to be quite a political issue. And then the sense is there any limit for any state to pay any of its bills?
This is kind of for everybody. Do you all have the same opinion on whether the Trump trade war is misguided or whether it's a smart thing right now?
Trump trade war, yes, no, good, bad. Paul.
It's like Deng Xiaoping said about the French Revolution. It's too early to tell.
John.
I would say basically, disruption is great. Everybody loves disruption. Disruption without an objective is chaos. And we have to believe that somehow Trump has some objective that he's going to over time. The other side, to me, is a simple argument that this has been a problem for a long time. And now we're finally facing up to the fact that there are some real inequalities with respect to trade. And we've got to deal with it both with respect to Europe and China. Hate to draw parallels, but you let these problems persist for long periods of time, and at some point in time, the whole thing blows up. So when you go to Mount Rushmore, which many of you probably do, there's no picture or edifice of James Buchanan or Millard Fillmore or Franklin Pierce. There's one for Abraham Lincoln. And he created chaos. He had a civil war to deal with, but at least he got the problem at least on the way to being solved. And so, you kind of get that feeling that, okay, that's great, you finally deal with these issues like immigration and trade, but do you have a direction where we're going, or are we just, shooting a shotgun at 15 different targets at the same time? And that gets very confusing. So I'm still in a position, yeah, it's a good thing to get this thing going. I don't know what the hell your direction is going. And it bothers me you're picking out India, then you're picking out France, and then Germany, and next week it's Nigeria, and 3 weeks from now it's Guatemala. I have no idea what the hell you're doing.
Bill, Trump trade war. Got a minute.
Our trade policy creates uncertainty. I'm a risk manager. I hate uncertainty. My clients hate uncertainty. Investors should hate uncertainty. Whether it turns out to be good for growth, we will find out. It'll take time. But for the foreseeable future, U.S. policy, fiscal, monetary, trade, is one of the biggest drivers of volatility in capital markets until it's not.
Trade, 30 seconds, Dick.
30 seconds.
30 seconds. 29, 28, 27, 26. Go.
Simple. I think the trade issue is appropriate. It's interesting how we've evolved to now everybody agrees it's appropriate. That wasn't the way it was 2 years ago. The problem I see is nobody gave Trump the book, How Do You Get to Yes?
One more question, and Justin has something for 5-6 minutes. Am I right, Jill? All right, one more question. Oh, Don. Yeah, one more question, please.
I would just answer this last question. And Trump measures his success by the Dow. If he's the reason why the Dow's going down, he can make it go up. So, I mean, we're at all-time highs today, right? So, did we hit 3,000 on the S&P 500? So
It hit 3,000,
Just real
briefly.
If you think he's making the market go down, he'll make it go up because that's how he measures his success. But I wanted to steal your question for Dick and direct it to Paul, if possible. Your first question.
Go.
And that was, what? Can you repeat your question to Dick? It was exactly if you're going to make an investment.
Single best investment idea today.
Dividend-paying U.S. equities.
Dividend-paying U.S. equities. Okay, what's our time? We're done?
If there's another question, I'll allow it.
There's the boss. Let me just add one comment. We have a lot of private equity folks in this room, and we have a lot of folks who construct their investments around equity. And I was having a discussion earlier with Scott Keller about another way to look at that. If you believe you're in an environment where equity risk is growing and it's something that you're undertaking because, as an equity investor, you're doing it in this platform of 1% and 2% interest rates nervously, there's another alternative, which is a royalty system. And as an investor, you determine to take a royalty system off of the revenue with the right protection and claim and seed the equity upside for the senior position. And some people are doing that, and I shared with Scott an example of that earlier today. Now, what does it mean? You give up a piece of the big equity kick, and in return, you lower your risk in an environment which is very risky in the eyes of some. I'm one of them. In our firm, which has a few billion under management, we approach that now because when companies, as you heard here, borrow money at 2% to buy back their shares, they're leveraging up the equity. And that only works as long as it works. And when the private sector does a similar thing, creates a different environment the same way. So those who are private equity investors may want to think about a top-line royalty structure to supply capital as opposed to a bottom equity structure. It's a different structure, but it can work. One more question, you say, Jill? Anybody? Last question.
We just heard that millennials are going to be the biggest group, or are the biggest group right now, and they seem to be infatuated with Bitcoin. What do you think is going to happen with Bitcoin in the next 10 years, I guess?
Lightning round on Bitcoin. Next 10 minutes or next 10 years? You pick. Real quick. 1, 2, 3, 4. Dick. Bill.
If that chart that I showed with the target, those circles were volatility, I'd have to have a new chart to put Bitcoin on there. I think the blockchain technology has real application across many industries and manufacturing and real estate, and could be disruptive to the legal profession. From a currency basis, I don't think so.
John, Bitcoin.
I think it's speculative money. I don't think it's a long-term investment. If you want to have fun, but that's all the game is.
Paul.
It's a digital and inferior equivalent of gold, and the energy costs of creating more Bitcoin are just becoming prohibitive, and it's just not going to work.
Ladies and gentlemen, we've met here in the heat, in a conversation. We had a panel. I hope you enjoyed it. Please thank this panel. Don.
Okay, thank you very much, David. So we have some very special members of the audience here today, and so we have a little bit of time left. I'd like to turn the microphone over to Rommel Mitchell from Microsoft.
All right. Thank you. Thank you. And I would love to come back here next year and hear a little bit more about Bitcoin. This discussion is great, well, at least blockchain. But in any case, just wanted to thank everyone for today, and I think we have a very special guest this evening. We've been working with an organization called Back to Space, and this organization, as we've been here over the last few days, it's been about entrepreneurship. This is a new initiative, and we have one of the members of that particular team from Back to Space here, Danielle Russo. So I wanted to introduce Danielle. It's an organization, as we think about the next frontier of space, the next frontier, as we think about the 50th anniversary of Apollo. That's coming up next week. We're going to be at NASA next week, celebrating that in Florida, celebrating that. There is a new initiative around the globe that's focused on space as a new economy, a new frontier again. And so Danielle Russo with Back to Space is the Senior Vice President for Communications, or Chief Communications Officer. So I wanted to introduce Danielle. Danielle, thank you.
Hello, how's everyone doing? Great. First of all, thank you, Ramel, for that very nice introduction. And Justin and Randy, thank you so much for having me. This has been absolutely phenomenal. I feel truly privileged to be able to listen all day. I've just been blown away with the presentations and the knowledge that I can walk away with. It's pretty enlightening. And what I love about this is I think being here and exchanging the information and the knowledge is going to change the future. And I think that that's something that me and my company were very interested in doing. And for me, the future involves space exploration, and every country in the world right now has a strategy. And America used to be the leader in space exploration, and right now we're a little bit behind. And I would like to change that. So just a little bit about me. My grandfather was on Apollo 14, and my other grandfather was a scientist for the Apollo program. So it's pretty safe to say that space is in my blood. And I had an opportunity to work at NASA while I was at the University of Massachusetts. And I worked on the Mars Curiosity rover, and I loved it. And I was so excited to share it with my peers. And someone actually asked me, didn't NASA go out of business? Guys, no. Someone asked me, it wasn't a question, it was more of a statement. They say, my favorite astronaut, yeah, that's Lance Armstrong. No. So there is a fundamental lack of interest in space. Thankfully, right now, we're coming up on the 50th anniversary of Apollo 11. So we have an opportunity here. So I've created a company called Back to Space. It's a transmedia company that focuses on inspiring the next generation of space explorers. So how are we gonna do this? Well, before I tell you, why don't I show you? Can you go ahead and play this little video?
And our astronaut crew has just left their crew quarters. Liftoff. We have a liftoff.
talked a lot about millennials, right? I'm one. I'm 27 years old. And there's a way in which we can engage the next generation, and that, in my opinion, is through media. We have this show we've pitched it all over LA. It's actually in the process of being picked up, knock on wood. We also just recorded a podcast with some shuttle astronauts, Apollo astronauts, as well as very well-known celebrities. And we're taking the digital media sphere by storm. So all in all, when we're talking about the future, I think it's important to look at the past. And I've noticed a lot of the presentations about economics also deal with looking at the past to look to the future. And that's what we need to do with space exploration, because there is no doubt that we are going back to space. And that's why I created the company, Back to Space. If you have any questions about what we're doing, feel free to come up and talk to me. And thank you very much for listening, and I hope to talk to you all soon.
Okay, thank you very much. So that's going to conclude our program for this year. I hope everyone was able to take away something useful for their personal process, for their business process, and let's say the discussion can continue as we meet around the tables here. So let me also say thank you to Jill Fornito, who has helped put this together as always. Jill. Thank you. And again, a reminder that all the presentations that the speakers have allowed us to post will be on the website interdependence.org. Thank you very much.